All right, let's jump straight into this explainer. Today we're tackling the absolute final, incredibly heavily regulated phase of dismantling a limited liability partnership, or LLP. We're going to get right into the nitty-gritty of Rules 235 to 245. So if you've ever wondered how the ultimate unspooling of a corporate entity actually happens on the ground and the super strict rules governing the liquidators who do it, you are in the exact right place. Let's get started.
Think about it for a second. How do you legally tear down a business piece by piece without total chaos ensuing? Imagine you're the liquidator in charge of an LLP's dissolution. You're basically running a legally binding, high-stakes garage sale, but with one massive catch. The tribunal acts as the ultimate gatekeeper for literally every single move you make. You definitely can't just handshake your way through this process.
Here's our roadmap for today. We're looking at 1. Settling claims, 2. Selling the property, 3. Distributing to creditors, and finally 4. Returning assets to partners.
Starting right off with Section 1, settling claims. This is our first critical phase.
Right out of the gate, Rule 235 lays down a massive boundary line. No claim by the LLP against any person can be compromised or abandoned by the liquidator without the sanction of the tribunal. The real takeaway here? While the liquidator goes out into the real world to do the heavy lifting and negotiate these compromises, absolutely nothing, and I mean nothing, can be finalized or swept under the rug without a judge's explicit permission.
And Rule 236 outlines the exact mandatory sequence for this. You can't just casually ask the tribunal for a favor. Step 1, you draft a proposed compromise. Then comes Step 2, which is absolutely crucial. The liquidator has to file a sworn affidavit, a legal promise, stating that they are completely satisfied this deal actually benefits the LLP. Only after that sworn statement is filed do we hit Step 3, where the tribunal reviews it and potentially gives the green light.
And the tribunal? They don't make these decisions in a vacuum. They can actually direct notice of the application to a committee of inspection, which is essentially a watchdog group representing creditors, or honestly any other relevant person they see fit. This adds a really powerful layer of transparency before any corporate claim is just abandoned.
All right, moving to Section 2, selling the property. Time to liquidate those assets.
So, under Rule 238, a liquidator can't just stick a for sale sign on the factory door and wait for a buyer to stroll by. No way. To ensure everything is fair and totally above board, the liquidator must use an agent or auctioneer specifically approved by the tribunal. Plus, they have to stick to some very precise methods: a public auction, inviting sealed tenders, or a specific manner directed by the member. It's a highly controlled environment, entirely designed to maximize returns.
Now jot this number down because it's a huge exam tip straight out of Rule 237, 60 days. Just because the gavel drops at the public auction doesn't mean the sale is legally over. Every single sale of LLP property is subject to confirmation by the tribunal, and the tribunal has a window of up to 60 days to pass that order of confirmation after the liquidator files their official report.
Rule 239 brings in some incredibly strict cash flow controls. Listen to this. The auctioneer doesn't just get to skim their commission or expenses right off the top of the sale proceeds. Nope. The rules state they must hand over the gross proceeds directly to the liquidator first. Only after that are the charges and expenses paid back to the auctioneer, and even then, it's strictly in accordance with fixed scales approved by the tribunal. The liquidator always holds the purse strings.
Section 3 now, distributing to creditors. Getting that cash out the door.
Before a single rupee leaves the bank account, Rule 240 demands total compliance. For creditors, you literally cannot declare a distributable sum without first filing a list of creditors and getting tribunal sanction. For partners, you need the final settlement of the list of partners. Again, completely sanctioned by the tribunal. There are no shortcuts here. You cannot bypass the tribunal's oversight.
Communication is totally paramount under Rule 241. You can't just surprise creditors by suddenly wiring them cash. The liquidator must give notice of the declaration of the distributable sum not less than 1 full month prior to the payment date. This heads-up happens via a public advertisement using Form Number 82 and a specific private notice to the creditor using Form Number 83.
But hey, what if the creditor wants the money sent somewhere else? Well, Rule 242 steps right in. A person owed a distributable sum can lodge a written authority, specifically using Form Number 84, that tells the liquidator to pay that sum to another named person. This creates some much-needed flexibility, right? It allows creditors to legally redirect their incoming funds if they have their own bills to pay.
Rule 243 mandates a really tight ticking clock, 45 days. The distributable sum must be transmitted within 45 days from the exact date the list of creditors is filed before the tribunal. The whole system is designed to ensure creditors aren't just left hanging endlessly once those lists are locked in.
So, how does that money actually move? Safely. Rule 243 authorizes highly trackable methods: registered post, checks, demand drafts, or other appropriate modes approved by the tribunal. Notice the common theme here? To avoid funds magically disappearing in transit, the payment must be easily traced. And crucially, the law explicitly notes that this transmission happens entirely at the request and risk of the person receiving it.
Which brings us to our final section, Section 4, returning assets to partners. Time to settle up.
Because partner equity and status can easily bounce around over the course of a business's life, the liquidator can't just guess who gets what share. Under Rule 244, every single order authorizing a return to partners has to append a tabular list, specifically utilizing Form Number 85. This has to explicitly show names, amounts, interest, and, this is key, any variations in the list of partners that have popped up since the initial settlement date. It's a precise mathematical map of exactly who gets what.
Now, Rule 244 presents a really interesting operational contrast. The initial notice, the letter just informing a partner that a return is coming, is sent by simple, ordinary post, using Form Number 86. But when it comes to the actual payout, the transmission of the money itself, the security gets a major upgrade. The actual payment needs to be sent by registered post. And again, that transmission is at the risk of the partner.
Which brings us to a highly practical, albeit slightly grim, problem. What happens if a partner or creditor tragically passes away during this long, drawn-out dissolution process, and their estate is only owed a nominal amount of money, say exactly 500 rupees? Do their grieving heirs really need to drag themselves through the court system to get a formal succession certificate just to claim a few $100?
Thankfully, no. Rule 245 provides a fantastic little exception. For claims due to a deceased creditor or partner that amount to 500 rupees or less, the liquidator can totally bypass the need for an official succession certificate. If the liquidator is satisfied with the claim, they just grab a personal indemnity, which is essentially a legal promise from the payee saying they'll cover the money if a better claimant suddenly appears later. It saves families from spending thousands on legal fees just to claim a tiny 500 rupee inheritance.
Today we're going through this explainer on the dense legal procedures of winding up a limited liability partnership, or an LLP. You can kind of think of this as the logical final chapter of closing down a business storefront. I mean, you can't just flip the sign to closed and walk away, right? There are floors to sweep, accounts to settle, and literal keys to hand over to the state. So we're going to make perfect sense of the very specific rules that govern this whole final shutdown process. Go ahead and grab your notepads. Here is our roadmap for mastering the final stages of LLP winding up. We'll hit 1, the final audit, 2, settling unclaimed funds, 3, officially concluded, 4, undoing a dissolution, and 5, appealing to NCLAT. Let's get right into it. Okay, let's dive into part 1, the final audit, closing the books. Now, the termination of winding up follows a very exact sequence under Rules 246 and 247. And look at how this sequence turns what's normally a dense block of legal text into a simple, easy-to-follow staircase of actions. Step 1, the accounts absolutely must be audited. Step 2, the liquidator files their final account with the tribunal, and they use Form Number 89 for that, and they apply for an order of dissolution. Step 3, the tribunal actually hears the application along with the liquidator and any other relevant parties they've called in. And then finally, Step 4, the tribunal officially orders the dissolution of the LLP. But I want you to notice the absolute strictness of Rule 246 here. It literally says, application shall not be heard until the accounts are audited. This is completely crucial. No audit means no hearing. End of story. The tribunal needs absolute, verified proof that the math checks out before legally pulling the plug. It's kind of the ultimate safeguard. Moving on to part 2, settling unclaimed funds, the leftovers. Because, in the real world, shutting down a business isn't always a perfectly clean break. You very often have leftover cash, or what the law officially refers to as a distributable sum payable. So what actually happens to the cash that nobody stepped up to claim? Well, under Rule 248, the liquidator basically acts as the final cleaner. Once that order of dissolution is made, they can't just leave the money sitting on a table. They must forthwith pay any unclaimed sums for creditors or undistributed assets refundable to partners directly into the LLP's liquidation account in the Public Account of India. It's essentially a highly secure, state-mandated lost and found. And here is the absolutely crucial detail: 30 days. Let this number serve as a massive anchor for your notes, for sure. Because the exact moment the tribunal makes that dissolution order, a really fast clock starts ticking. Within that 30-day window from the date of the order, an exact sequence of compliance has to happen. First off, a copy of the dissolution order must be forwarded to the liquidator in Form number 11. Form 11 is your bright, shiny badge here, so definitely commit that to memory. Then, the liquidator has to actually make a minute of the dissolution in their books. Next, a copy is filed with the registrar. And finally, the liquidator signs a statement certifying that all the tribunal's directions regarding the balance of funds have been totally complied with. It is quite literally a sprint to the finish line.
Which brings us to part 3, officially concluded. When is it actually over?
Under Rule 249, we really have to ask, when does the law officially recognize that the winding up process is fully concluded? Now, you might be thinking it's the moment the gavel drops, but actually, scratch that, the law is much more nuanced. Notice the crucial difference here. This is a classic exam trick question, so heads up. If the LOP is wound up by order of the tribunal, the winding up is deemed concluded on the date the liquidator reports the dissolving order to the registrar. But if it's a voluntary winding up, it's concluded right at the date of dissolution, unless, and this is a big unless there are unclaimed funds or assets still sitting around. If funds remain, that voluntary winding up is not legally concluded until every last cent is properly distributed or paid into the LOP liquidation account. All right, take a breath, because just when you think the whole shebang is over, we get to part 4, undoing a dissolution, the plot twist. I know it sounds a bit like corporate necromancy, doesn't it? Like, can a dead, completely dissolved LLP actually come back to life? Well, under Rule 250, the answer is, technically, yes. If a mistake was made or maybe some new critical information comes to light, the law provides a very specific mechanism to resurrect the entity. So here is how that revival mechanism breaks down on a timeline. From day 0, which is the date of dissolution, the liquidator, or really any interested person, has a massive 2-year window to apply to the tribunal to declare the dissolution void. They just have to give notice to the central government and the registrar, and if the tribunal agrees, bam, it's as if the LLP was never dissolved at all. But notice the catch at the very end there. Once that void order is made, there is a super strict 30-day scramble for the applicant to file a certified copy of that order with the registrar. You don't want to miss that window. Finally, we reach part 5, appealing to NCLET, the final word. So, looking at Rule 301, if someone feels deeply wronged by the tribunal's decision during this whole process, there is still one final boss to face. And that is the NCLAT, which stands for the National Company Law Appellate Tribunal. If any aggrieved person feels an order made by the tribunal was incorrect or unjust, this is the designated appellate body they take their case to. They are the absolute higher authority in this specific legal arena. But as always in law, justice is strictly tied to a calendar, 45 days. This is the final major number you really need to memorize from this explainer. An aggrieved person doesn't just have forever to complain about it. They have exactly 45 days from the date the tribunal's order is delivered to them to prefer an appeal to the NCLAT. If you miss that window, that's it. The original order stands forever.